Good morning, class. This is your instructor, Haka. Today we are going to be talking about how to practically solve the balance sheet issues, and they're all related with the accounting equation, which is assets equal liabilities plus owner's equity. So now, as you can see here, we have the key terms, and I'm going to be talking about chapter 2's exercise and problem questions. So we've already covered the exercise questions. Let's just move on to the problem set A. And besides this, you are to study about the demonstration problem, the self-test questions, discussion questions, brief exercises. Because exercise question I think has been discovered, it has been already discussed in the previous lecture. So now this problem set A is primarily what we are going to be talking about, because problem set B is very similar to problem set A. The questions that are in both of these usually have the same level of queries in them, and any kind of adjustment that is required, usually they have the same nature. So let's just begin with problem set A. Okay, so since I already gave you the first question in assignment, let's just look at how you're supposed to interpret the effects. And if you can just see that this is the learning objective 2-3, and this learning objective is, if you just go back to the chapter, and let me read the question now. The following 6 transactions of Memphis Moving Company, a corporation, are summarized in equation form. Now they have given you various adjustments. You are supposed to interpret this. So if you can just look at it, closely, you see that this is an accounting equation. This is assets equal liabilities plus owner's equity. Owner's equity comprises of the funds that you inject into the business at the time of starting of the business. They could be your savings, and the shares that you sell when you want funds from the public. So when you sell the piece of paper, for instance, initially, that is known as initial public offering, and that is via the bank. So any commercial bank would help you float the shares to the public, and the public will then invest after a process of balloting. So if, for instance, there are 1,000 investors and you only require 100 to give you funds, so you don't require funds from 1,000 people, but there are 1,000 people who are willing to give you funds. So there's going to be a process of balloting that who you choose would be the ones giving you funds. So in that case, after the process of balloting, then 100 people are chosen, and then they are given a piece of paper, and which would entitle them ownership, a very small portion of ownership, up to the number of shares that they're willing to purchase. So the shares are nothing but a promise that the company would give them a value for the shares in terms of money in the future. So if they sell this piece of paper, they will be getting money in lieu of that in the secondary market, because this market will be the primary market or the initial public offering. Now, if you go into the further details of this, you can also Google this. You can go and read up on this chapter. In this chapter, there are details along with chapter 3, and you can also skip. You can just simply search in the book, and then they can take you to the place where the shares are explained in further detail and they're elucidated upon. So now the balance, now when you have something like this, A, B, C, D, so first these are the balances that are given to you. Now this is a question which requires solution on a piece of paper, and I'm going to be explaining to you how you're supposed to do this. So for instance, how are you supposed to interpret the first term, A? You don't have to look at the numbers and get really confused. You just have to see what they ask you. So now they are asking that from each of the transactions A through F, write a separate statement explaining the nature of the transaction. So I'm going to be talking about the transaction and the statement, what is the nature of that transaction. So they have also given you an example, so the explanation of transaction A. So they have given you an explanation of transaction A, that following this model you will be able to, or you will be liable to explain the further transactions and further parts. So if, for instance, you have part A, the explanation is given as follows. So you have purchased equipment for cash at a cost of 3,200. So now how do you know basically that you have purchased equipment? Because see, there's a minus sign here. Let me just further bring it up a bit, adjust this. Okay. So now you see, you have to see the recording effects of this. Similarly, 2-2.3 is also the same way. You have to see the recording effects of this as well. So how are you going to interpret this? So we have 3,200 with a minus sign. Had it been with a positive sign, then we would have said that, okay, cash came from some source. Either it was loan, or maybe you sold off some equipment. Because all you can see is assets, liabilities, and owner's equity. And the third option or effect could be that probably he issued more stocks. The company, initially the starter of the company. So for instance, Microsoft was started with Bill Gates, At that time, he was the main chief owner. Unless and until the company becomes publicly listed, its owner is the sole proprietor of that company. And then that company becomes publicly owned. Okay? So now in this case, initial balance, all these balances are the opening balances. Okay? So any transaction within A, B, C, all these alphabetical parts that you see, these denote that the effects have to be taken into account, and then you explain. So for instance, part A will say that minus 3,200 denotes, or it indicates that cash was subtracted. So that there's cash is credited. How is it credited? And then equipment was debited because you purchased equipment. So what will be the entry? In this case, you see that cash is credited, equipment is debited. So I can write here, this is a credit here, and there's a debit here. So net effect is 0, because as much as credited is debited. Okay, so as much as credited, it is debited as well. So minus and plus give you a 0 in total. Then part B is that there's an increase in cash by 900. So now you're going to debit this cash, and you see that this is credited in the same side. So if you are to move the transactions in the same side, then their signs have to be reversed. Because you can't really increase cash and then increase accounts receivable, because then that won't balance. It's going to be a double entry on the left-hand side. And you have to balance the left-hand side and the right-hand side. So if, for instance, how do you balance the right-hand side? Because if accounts receivable is reduced, it has to be credited. So then, if cash is added, that means now what does the interpretation require you to write? The interpretation would be something like the person got his accounts receivable settled. Now, how do you settle it? Because initially, perhaps there was some trade debtor. You know what is a trade debtor? Someone who would promise you that he's going to pay you something, but it's not going to be a written promise, it's not a promissory note. He's just going to verbally, perhaps, since it's an accounts receivable, not a notes receivable, it's not a promissory note. So, he is going to, that particular trade debtor will, maybe it's just an understanding with you, something like N by 20. The number of days in which he's going to be paying you for any items that he might have taken from you. So you purchase the items from a supplier and you sell it off. Or you manufacture those items and then you sell them off. So in that case, where you sell them, the person has to pay you money in the form of revenue. That will be a source of revenue for you. So he's not going to be paying you immediately. What he's going to do is perhaps give you, maybe take some leverage of 20 days, 10 days, and then pay you after that time period, span of time. And this is N by 20 or N20, something like this, this N20, N30. So this is the time frame within which he's going to make the payment. So this is accounts receivable for you. But if you pay to the supplier, then it's going to be accounts payable. It's going to be your liability. In this case, this is the current asset. So now the main entry that you are going to do when an accounts receivable is created is that you debit that accounts receivable, because that is your current asset. But in this case, as you see, since there's a minus sign here, it means that this was credited. Now the original nature is debit. So what is the effect? Let's just do the effect. So I'll just explain to you now. So initially what happened was that accounts receivable was created for maybe this was 39,000 to whatever inventory that you had for $39,000. Now assuming this is inventory, it could be anything, it could be services rendered. Now when you have this second part is that this partially was settled. So then accounts receivable, if it is settled, then it is reversed. In accounting, you usually do not have signs representing the reversals. Alright? So signs would just be indicative of the transaction's nature. Transaction's nature is indicated by the signs, but when you do journal entries, what you do is that you're going to reverse it partially. So it's going to be credited. So this is going to be accounts receivable by $900, and you got cash in lieu of that. So cash was debited by $900, and in this case it shows that cash was debited, so it increased. Initially, as you can see, the equipment was bought in cash, so there was cash that was 26,000, but then you got equipment. So this equipment to cash. So this was our first transaction to cash, that was 3,200, okay? Because you purchased that equipment. So this is the way you're going to be attempting this problem. By explaining as well as for your own ease sake, you are going to be doing the journal entries or making these entries. Now let's just take up the next problem. So now, next part, you see this is C part. Again, the cash is credited, as you can see that this is credited. And in lieu of that, suddenly there's an equipment which was purchased for $13,500. Now you might think that the cash was only credited for $3,500 and the equipment is for $13,500. So there's no balance in that, how you balance. But if you just look at the liability side, then you'll know that there's a accounts payable by $10,000 because the equipment was purchased, and there's an accounts payable because you don't pay the rest of the money, and that rest of the money will be coming forth later on. So it's not a written promise, again it's a verbal promise, so then the entry is going to be something like this. Okay, so we've already read the questions. Main feature. What it says is that the cash is credited, as you can see with a minus sign, at least credit 3,500. Now what was added as accounts payable in that? But what did you have? Equipment. Equipment for 13,500, so this is a debit. Okay, so this is debited and that is credited. But since this is not making sense because it's not fully complete as yet, so in order to make full sense of that, there's further credit of accounts payable, and that would be $10,000. And now as you can see, this is balancing. And you have to do all the entries like that. It's very easy. I don't think there's going to be much of confusion if you can just simply, this is just 13,500. And now they're equal. So you have to equate them. Let's just see one more example, then we have to move on to the next question. Okay, let's just do the last part F, okay? Or perhaps the capital stock one. Okay, so now this is very easy for you to understand. We've already done this several times in the examples. So if cash is increased, capital stock is increased. Okay, so now you might think that they are both increasing, but since they are both increasing on the opposite sides, so that means that the left hand side is equal to right hand side, so it's already equal. But now for the next, this is F. C, equipment is increasing, so you debit the equipment, and you credit the accounts payable, because when the liability is increasing, it is always credited. So now you credit the accounts payable and you are going to debit the equipment. And similarly for here, you are going to be crediting the capital stock and you're going to be debiting the cash. So I hope that you can make the journal entry and make sense of these. And this is, okay, now this transaction has both negative signs. So now cash is reduced, you credit it, and then you have accounts payable which is offset. So that means basically that, this is debited. What it means is that probably you settled your payment, it was a payable, and you settled it by giving cash to the person you owed money to. Okay, so now the supplier that you owed money to, after a span of period then, or a span of time, you gave him cash of $14,500 for the equipment that you purchased, or perhaps the supplies that you had from him, or any kind of inventory that you got from him, and you pay the accounts payable, you settle it in other words. Okay. Now we're done with this question essentially. You make the journal entries and you can form the ledger. I've already explained to you how you're supposed to make the ledger. If you have any questions with this, you can ask me. Oops. Okay, now let's just look at the question, which I can pretty much. Okay, look at this question now. It's a very important question. Notice that in chapter 3 we've done the revenue portion. In here you are supposed to make the balance sheet. You have to do the demonstration problem, you have to do the accounting equation, and all the examples that have been done in the chapter. So then you'll be able to handle this problem. So first of all, now if you look at this, that this is sort of like a haphazard balance sheet. And there are no expenses and no income. First of all, when you get such items that is a hodgepodge, you're going to separate or sift out the receivables and payables, and you're going to write down what are the assets. And assets are of two types, as I've told you before. And one is the current asset and the other is the fixed asset. And there's something which is in between, and something like supplies, which are like the current and fixed. It's just something in between, because in current usually you have accounts receivable, you have the cash and the closing inventory, more or less, and the notes receivable. So now these are, this is the, you can say, current assets. So now when you're making the balance sheet in this, you're simply going to be sifting out what is the equipment, what is the accounts payable. I'm going to be making the balance sheet after the adjustment, because simple balance sheet, they've asked you prepare a balance sheet at August 1 current year. So for current one, August 1 current year, you're simply to arrange these terms. So you know, first of all, you write the cash, and you can also make the statement form balance sheet. I'm going to be making the statement form. You can also form the T account form. So we have the cash first of all, then you have accounts receivable, then you have the building, equipment, and land. So you add these up on one side. So that means this is going to be the current assets, and this is going to be the current asset. This is the fixed asset. So current asset is going to be this one, accounts receivable and cash, and equipment, land, and building, they are going to be the fixed assets. Similarly, your supplies are also assets in between. So something like that, I'm going to be arranging these. Okay, so now first of all, you have the balance sheet, or I should be perhaps writing it on the Word format for you. Okay. So now, if you note that I require statement form of balance sheet, let's suppose. So initially there's a balance sheet as at August 3, 2019, or whichever year it is. But remember that you also have to write this as at, but for income statement you write for the year, okay? And so first of all, I'm going to be, since putting it in the statement form, you can from this determine how you're supposed to do the statement form. So it's cash first of all, then you have accounts receivable, then you have I think they're pretty much two things. So cash was initially 6940. You're just going to add them up yourself. We have 11,260, and they're dollars. And then you have, these are the current assets just for your ease. Then we have fixed assets, but before that we have supplies. And supplies has cost us $7,000. Then we have fixed assets as there's equipment and building. Okay, so first of all, if I have maybe building, then equipment and fixtures. You can also have equipment first, building later. Let's just write equipment first. Equipment, building, plant and machinery. Okay, so now equipment is 44,500. We have building as 84,000. Then we have plant and machinery. We have, so this is equipment, building. Okay, so we don't have plant and machinery here. We just have land. So let's just write land. And land is 67,000. So you arrange these items. Now you have liability. So you're going to continue with the statement for balance sheet. Okay? I'm going to make the same thing for the next part. Balance sheet, August 3. This was perhaps for August 1 or something, just the main version. Then you can just continue with here, because in the statement form you continue just down. This, since there's lack of space with me, now you have liability side, which is the current short-term liability. The term that you use is short-term. We have accounts payable. Accounts payable for $16,200. Then you have notes payable. Notice that they are short-term liabilities, 74,900. You have salaries payable for $8,900. And then you have equity. Okay, so equity is capital stock, but you could also have retained earnings. So capital stock is $80,000, and you want to add this first as a subtotal. This is going to be your subtotal, and then you add this as a grand total. Okay, and the assets, that you can just simply add them and see that they are both equal or not. Let's just find out if they're equal. $6,940 plus $11,260 plus $7,000 plus $44,500 plus $84,000 plus $67,000 plus because this is $2,700. Comes to about $2,700. Let's just see. How much is this? Now 16,200 plus 74,900 plus 8,900 plus, okay, this is equal to 100,000. This is 100,000. And this is going to be, the grand total will be 180,000, so this is not equal at the moment. So now that means that something is missing in this. Now what is that something? So for August 1, we need to further check, are there anything missing in our total? We, I think, added everything. The retained earnings is missing, okay? So let's just see what have they asked us. So now you are to compute the missing figure for retained earnings, okay? So how do you compute? You just take out the difference. So now what would be the difference in this case? As you can see, this is 180 and this was 220,700 less 180 and the retained earning is 40,000. So now retained earning in this case RE would be 40,700 and the total would be again 220,700. So this would be balanced with this one. Now when you take account of all these transactions, I'll just tell you how to do the effect of these transactions. Okay. Now what happened during the next 2 days? Now if you look at, you see that the capital stock was sold for $25,000. So now your cash should be having plus $25,000. Okay? So that means the total should be more. So if I make a ledger of the cash, how am I supposed to make the ledger? Ledger would be like cash account. Initially was $6,940 for as the opening balance on August 1st. And there's a date, okay, so this was, let's suppose August 1st. Now, when you had further cash, so this was going to be 45,000 against capital stock on perhaps 2nd August, on maybe it was 2nd August or whichever date, let's just confirm. So this additional was sold for, let's just confirm the date first. So yes, 2nd August. So this was sold for $25,000. So I'm going to be adding on 2nd August. So now this is still not complete because the equipment was purchased at cost to be paid within 10 days and supplies were purchased for 1250. Okay? And accounts payable were paid in full. Now you know that so you got the capital stock, you got further cash. But now accounts payable were paid in full in this case. So that means, how do you settle an accounts payable? So initially accounts payable is credited, right? But when you are settling it, it means that it is debited to accounts payable. 16,200 to cash. 16,200, okay? Now that means the cash was credited. So I'm going to be writing here 16,200 as credited on against 2nd August for accounts payable, AP, sorry. And further, paid in full, and then equipment was purchased and supplies were purchased for 1250, so further 1250 for 3rd August, okay? So supplies, against S is for supplies. Now you can find out what is the total ending balance for cash, and that is going to be 6,940 plus 25,000 less 16,200 less 1250 and you get about 14,490. So carried down would be 14,490, and that total would be how much? So this is going to be 6,940 plus 45,000. So it's going to be 31,940 on either side. But this is the brought forward, okay? So now you're going to be having this as brought forward for the next period. Now, either you can end this here with a double line, but when you have to make it as a running ledger, there you're going to keep it open as a single line perhaps, or just keep it open. So now brought forward. I don't want to confuse you further with this. I'm going to rub this off, but you get the idea of how you're supposed to find the closing balance. Now this closing balance will be added. So now with this 14,490, now the cash would be 14,490. But now, as you see, we had the accounts payable settled. So now we are going to be removing this accounts payable from here. So there is no further accounts payable in our balance sheet. Excuse me. I've made certain changes to this balance sheet. Now let's just see if it balances at the moment. Yes. Okay, so what I did was I just put the plus sign because I want you to understand the initial balance sheet that we made. Now what changes we are going to make? First of all, we say that on August 2nd, the capital stock was sold for $25,000. I wanted to take the effects in cash and explain to you how you took the cash effects. Now out of this, accounts payable were paid in full, so I removed the accounts payable because it was paid in full. But then again there was another transaction which had accounts payable because you purchased equipment on account. So in that case, again accounts payable was created for 7,200. I created it again, okay? And then equipment was debited. So equipment account already exists. and you add the 7,200 in this. So the total figure would change from 44,500 to 51,700. Okay, so I'm going to be writing 51,700. Similarly, we have supplies as 8,250. So now supplies would be 8,250. And when you add these up, you get 22,36,700. But when on the other side, now you know that the capital stock increased to $25,000 plus 80,000. So initial, so you can just simply add them up, 80,000 plus 25,000, and you have 105,000. So this was 105,000. Other than that, the accounts payable was 7,200. So when you add these up, the figure that you get is 236,700, and this your question is complete. But now they're asking for another one. Which position is stronger? So now obviously in the second period, that is August 3rd, his position is August 1 is the current year, and then there's August 2nd and August 3rd. So in this period, they say that assume the notes payable do not come due for several years. Is Franklin Bakery in a stronger financial position on August 1 or August 3? So if they do not become due for several years, the accounts payable still, you can see that the subsequent period, their balance sheet is in a stronger position, which you have further enhanced total assets and with the capital stock increased slightly. So this is all about this. You can give your comments on this question. Let's move on to chapter 3. So I have done largely the questions, and you have to read them. But let's just do one problem. So this was your homework. Let's look at problem in 3.2a for statistical analysis. So now, analyzing and generalizing the transactions. So you read the instructions first, say that prepare an analysis of each of these transactions. So transaction 1 serves as an example of the form of analysis to be used. So the first one is on August 1st, the company billed customers $2,500 on account. So when they use this word on account, it means that payment is due, has not been paid as yet. So the company billed on account for services rendered. Whenever you render services, this is considered as revenue earned. Okay, so there's a term which is known as revenue unearned or unearned revenue. It means that you haven't as yet rendered the services, but you have accumulated or accepted funds or cash for it. So you are not going to be recognizing it in the revenue portion of the income statement. Therefore, the customers are required to make full payment within 30 days. Now, what you do is that you bill the customers, then that becomes your accounts receivable. So the journal entry that you're going to be making is accounts receivable, because at 2 services rendered for environmental services use an account titled testing service revenue. So I'm going to use the word testing service revenue for $2,500. Okay, so this is basically the transaction. This is debited and that is credited, and that is how you're supposed to be analyzing. And then you can make the general ledgers. General journal. After this, you can make the ledgers or from the general journal or the journal entries basically. So the second part is that the company purchases testing supply costing. So when you have supplies, and if they are used up, you should know that they convert into expenses. There are supplies consumed, and whenever assets are consumed, they turn into expenses. just like depreciation, when an asset is consumed finally, consumed like wear and tear or into obsolescence, but that would be writing off the asset completely, and that can go into loss. Similarly, when you sell the asset and it is above the cost, then it will give you gain. But if it is sold below cost, then it's going to give you loss. And we are going to be studying that in subsequent chapters. And in this case, the company purchased testing supplies costing $3,800, paying $800 cash and charging the remainder on account at Penn Chemicals. The testing supplies are expected to last several months. So now they purchase the supplies, you're going to debit the supplies. So you debit the supplies as $3,800 to, they paid cash $800 and charging the remainder to account. Now it's not notes payable. Okay, so there's to cash, it is $800, and accounts payable, which is the remaining amount of 3,000. Okay. Now you have to remember this transaction. Next is, moving on to the third one, the company returned to Penn Chemicals $100 of testing supplies that were not needed. So now the supplies will be credited. This is the second transaction. This is the third transaction. The supplies will be credited by $100. And what are you going to be debiting? Accounts payable, okay? Because the accounts payable will be reversed by $100. Then on the fourth number, the transaction says that on August 17, the company issued an additional shares of capital stock at $8 per share. So you just multiply $8 was 2,500. Okay, let's just multiply this 2,500 with 8. You get about 20,000. The cash raised will be used to purchase new testing equipment. So when you purchase that, you're going to be using it later on, but you're not going to be writing that effect at the moment. So for part 4, you have capital stock. So cash would be $20,000 to capital stock to CS, or common shares is $20,000. Then on August 22nd, the company received $600 cash from customers. It had billed on August 1st. So now on August 1st, as you can see that they billed customers $2,500 and they received $600 cash. So for transaction number 5, I can just take the effects here. As you can see, the company received $600 cash from customers. This is accounts receivable as credited because it was initially debited. So now you're going to take the effect in the reverse manner. So you are going to credit it, and this would be reducing this accounts receivable by 1,900, so to 1,900 basically, because you subtract 600 from it and you got cash of $600. Then you have part 6. On August 29, the company paid its outstanding accounts payable. So what was the outstanding accounts payable now? As you know, this was debited, and initially the accounts payable was 3,000. So subtracting the 3,000 from, subtracting the $100 from the 3,000, because this is debit and this is credit, so it is 2,900. Then you settle this remaining amount, so its accounts payable is 2,900. Then you have cash, I guess this is, where is this? To Penn Chemicals, and all the cash was 2,900, so this is credited, okay? And 7 is that on August 30, the cash dividend totaling 6,800. So when dividend is paid, remember this. So when dividend is declared, it is immediately written down as an expense. It was sort of like, it's not, if it is a preferred dividend, then you might add it in balance sheet, but usually dividends paid are not added in, not balance sheet, it's added in the expense portion, but for tax purposes, this is not recognized as expense. So remember that when you're putting it in income statement, at the moment when you're filing the tax returns, or you are going to be giving the tax, you have to add it back in your net income, because the tax authorities do not recognize it as an expense for tax purposes, and you have to add it back in the income statement. In the net income, after the net income has been deduced from the income statement. So you just add this back in the net income. Now the thing is that when you are giving cash and you declare the dividend, so now at that portion, at that time, you're going to be making the entry of dividend declared to dividend payable. But now since they declared and immediately paid cash, so you're going to be writing as dividend declared to cash, and cash was paid 6,800. Then you can also make the general journal. Once all these entries are made, accounts payable in a complete form, then you're going to be making the ledger from this, the journal entries. You have the accounts payable ledger, supplies, cash, and so you can have the balances beginning from 1 and then going to 7, starting with how much cash you have. So now, when for instance you make a T count for ledger, so all the entries for cash, as you can see that we have cash for 20,000, and we as account services rendered are required to make full payment. So now in this first entry you did not have any cash, okay, because this was just on account, so this was revenue earned, and there was accounts receivable, for instance. So in the second you have cash, as since they have not given you the opening balance, you can just simply leave it, but you can just have an idea of how you're supposed to make the ledger. Cash was debited by 20,000, and you can just against which this was common stock, and against which this was 800 against supplies. So you can simply say supplies, and this is since 2nd August or the 1st August. Sorry, so this is 1st August, and this is I guess 2nd August. No, sorry. This common stock is, I'm sorry, I think I've made a mistake here. This 800 is August 3. August 3, sorry, this is August 3. And the common stock transaction was on August 17th. So 17th August. Similarly, you can see where else is cash involved. Then you have cash debited for $600, and that is against accounts receivable AR, and this is entry number 5, so you can see this is on 22nd August. And then you have in the next again 2,900 is credited, and this was against accounts payable, and date was on 29th August. Okay, and then you have against dividends, cash was credited to 6,800 as dividend declared, and this was on 30th August. So that's about it. So if you don't have the opening balance, you can just simply see how much, and then you can just simply write carry down. Let's just add this 20,600. This is 20,600, let's suppose, and you can just simply add this up. How much does this come to? And we have 800 plus 2,900 plus 6,800 comes to about 10,500. So now, as you can see, we need to have the balance is 10,100 is the carry down, and this is 20,600. So like this. Okay, so now this is the right. This is just an example, and you can just simply bring it forward in the next period as 10,100. So similarly, you can make other ledgers if you want, and you can find out how to compare these transactions with a question and then with the ledger. And you can pose these into trial balance. The closing figures in the ledgers will be your trial balance figures. And I've already explained to you how you're supposed to make the trial balance. So just revise that. let's just repeat a little. We are going to be doing in the next class the cash flows, and I'm going to be just doing perhaps one question from the lecture, trial balance. And hope to see you in the next round of lecture, okay? So, thank you so much.